Right now, every time you save $100, rising prices quietly steal a few of them each year. You don't see it leave your account, but you feel it at the grocery store, at the gas pump, when your rent goes up. So let's picture this. One person leaves a few $1,000s in a sleepy savings account. Another person invests the exact same amount. Fast forward a few decades. Their futures don't just look a little different, they're worlds apart. You already know inflation quietly shrinks what your savings can buy. So the real question is, what can you do about it without gambling your future or turning into a full-time stock picker? Here's where investing comes in. Think of two paths. On path A, you keep $10,000 in a savings account, earning 1% for 30 years. It grows to about $13,500 before tax, barely more than you started with. On path B, you invest $10,000 in a diversified portfolio, earning an average of 7% a year. After 30 years, it can grow to around $76,000. Same starting amount, same person, very different choices. In this episode, we're going to explore three big ideas. First, when it makes sense to save and when it makes sense to invest. Second, how investing taps into the growth of businesses, technology, and entire economies. And third, why predictable, long-term investing can actually be less risky than doing nothing. Because your goal isn't to play the market. Your goal is to put your money where it can actually work for you. Let's start with the big picture. To decide what role investing should play in your life, don't just look at your current income. Look at your future obligations. Imagine a 30-year retirement. If that retirement costs even $40,000 a year, that's roughly $1.2 million you'll need in today's dollars. Now ask yourself, could you realistically save that much just by stashing money in a savings account from your paycheck? For most people, the answer is no. It's extremely hard. That's why most long-term goals, retirement, children's education, financial independence, assume your money earns a real return above inflation. Not just sitting in cash, feeling safe, while it slowly loses ground in the background. Here's the key idea. Saving and investing aren't rivals. They're tools for different jobs. Think of savings first. Savings are your safety net and your short-term money. That's your emergency fund, your upcoming rent, a planned vacation, next year's tuition. That money needs to be there when you reach for it. So with savings, you prioritize stability and quick access, even if the growth is tiny. Investing is different. Investing is for the money you won't need for several years. Here, your goal shifts from stability to growth. So what actually drives that growth? When you buy shares of a broad stock fund, you're buying tiny pieces of hundreds or even thousands of companies. As those businesses raise prices, improve technology, and expand into new markets, their earnings tend to grow. And over decades, that growth has historically translated into returns that outpace inflation. Let's make this really concrete. Consider three people each setting aside $300 a month for 30 years. Alex keeps it in a savings account at 1%. After 30 years, Alex has about $125,000. Jordan earns 4% in a conservative mix of bonds and stocks. Jordan ends up with around $210,000. Taylor invests in a growth-oriented, diversified portfolio, averaging 7%. Taylor finishes with roughly $365,000, same monthly amount. The difference between 1% and 7% is about $240,000, more than the total Taylor contributed. Now let's stretch the timeline. If Taylor keeps investing $300 a month for 40 years instead of 30, still at 7%, the balance grows to about $760,000. 10 more years nearly doubles the outcome. Not because of higher contributions, but because compound growth has more time to work. Let that sink in for a second. So what actually matters most here? First, your time horizon. The longer you're invested, the more powerful compounding becomes. Second, your return above inflation. If you're earning 6 to 7% when inflation is 2 to 3%, your money is growing in real terms, not just treading water. And third, consistency. Regular contributions help smooth out the bumps of market ups and downs. You invest through good times and bad instead of trying to guess the perfect moment. Notice what you're not doing. You're not trying to predict next month's stock prices. You're not glued to a trading app. You're aiming to own a broad slice of human progress for long enough that the short-term noise becomes almost irrelevant. Here's another way to think about it. Think of your money choices as designing a team. Cash is like a goalkeeper. It's essential for emergencies. You absolutely need it. But if everyone stood in goal, you'd never score. Investments are your forwards and midfielders, the players that actually win the game over a long season. The right mix depends on your match length. The longer your goal is away, the more room you have for those growth players. So how does that look in real life? Let's say you keep $5,000 as an emergency fund in cash. That's your safety net. Then you invest another $5,000 for 25 years at 6%. You still have safety, but that invested $5,000 can grow to about $21,400, over 4 times as much, without adding another dollar. Or picture 2 co-workers. Sam keeps all long-term money in cash and saves $400 a month for 25 years. After all that time, Sam has about $120,000. Lee keeps 6 months of expenses in savings, then invests $400 a month at 6%. After 25 years, Lee has around $250,000. Same total out-of-pocket savings. But Lee's mix of goalkeeper plus scorers creates more than double the long-term firepower. That's the difference a thoughtful mix of saving and investing can make. And this isn't just about numbers on a screen, it's about real-life choices. Looking ahead, investing can shape options like retiring at 62 instead of 70, working part-time instead of full-time, funding a child's education or helping a parent. For instance, a portfolio that reaches $600,000 and yields 4% can provide about $24,000 a year without touching the principal. Now connect that to your income today. If you automate a 10% contribution from a $50,000 salary, that's about $417 a month. You can build that kind of balance over a few decades. You're turning today's habits into tomorrow's flexibility and security. And you don't have to start big. Start small, but start. Even $100 a month at 6% for 20 years can grow to about $46,000. That's enough to cover a year off work, seed a small business, or cut your mortgage faster. So here's a simple way to think about your money. Decide what's for the next 2-3 years. That money? Keep it safe. Then decide what's for 10 years or more. That money? Put it to work. After that, automate your contributions so your future isn't left to chance or to willpower. All right, let's pull this all together. So here's what we covered today. First, doing nothing has a cost. Inflation quietly eats away at your savings. $1 today doesn't buy what $1 bought 10 years ago, and that's not changing. Second, saving and investing serve different purposes. Savings are your safety net and short-term money. Investing is for your longer-term goals, where growth matters more than day-to-day stability. Third, time, return above inflation, and consistency are your 3 power tools. The longer you invest, the more compounding works in your favor. Earning a few percent above inflation grows your money in real terms, and steady, regular contributions smooth out market ups and downs. Fourth, the mix matters. Cash is your goalkeeper, investments are your scorers. When you keep only cash for long-term goals, you limit your future. When you blend safety with growth, like Lee did instead of Sam, You create far more options for your future self. And finally, investing isn't about getting rich overnight. It's about turning small, repeatable actions, like $100 or $300 a month, into meaningful choices later in life. Choices like when to retire, how much to work, and what opportunities you can say yes to. You don't need perfect timing. You don't need a finance degree. You just need a clear plan for what's short-term, what's long-term, and a habit of showing up for your future self month after month. So, what can you do with this right now? Here's your action plan for this week. Number 1, take a few minutes to write down the key ideas that stood out to you about why invest, making your money work. When you write things down, you're far more likely to remember them and act on them. Number 2, identify one specific area where this knowledge applies to your life today. Maybe it's your emergency fund. Maybe it's that old savings account sitting at 1%. Maybe it's finally starting an investment account for the long term. And number 3, take one small action this week to apply what you learned. Just one. That could be opening an account, increasing an existing contribution by $25, or separating your short-term and long-term money on paper. If you do just those 3 things, you've turned this episode from information into real progress. And that's how your money starts working for you instead of quietly slipping away in the background.